there was a question that had come in during the week that I found interesting because I learned something a little bit more in depth than I knew, and I wanted to share it. So why stocks change strike intervals from time to time, why you might have seen a 50-cent strike difference on a stock and now you only see $1 strike differences, or you were used to trading $1 strike differences on a particular stock with weeklies or other expirations, and now they're up to only 250 or even 5 points. The question came from Robert, and Robert had emailed in. He said, I trade mostly weekly options, 50-cent to dollar strike difference. And Robert noticed that those strikes can change. He was having a hard time finding any information as to why a stock would suddenly change the different intervals you can use between strike prices on an option chain. His one example was Apple, usually offered $1 strike intervals, but now they're only available at $2.50, and at some prices they're only available at $5. HPE was another one, Hewlett Packard Enterprises, usually 50-cent intervals, but in the last month it moved to only $1 strike intervals, and he wanted to know, why does this change occur in those positions? Well, I knew it was related to the stock price, but there was another caveat in there as well that we found out. As early as November 8th, as recently I should say as November 8th, over here on the left, HPE did offer the 50-cent strike differences. We were able to see 13.5 strikes, 14, 14.5, 15, 15.5, and more. But today, looking at a chain going out only 7 days, even though it's standard expiration next week, but even all of the weeklies are just 1 point stock differences. And the stock is pretty much the exact same price on both days, $15.44 on November 8th versus $15.39 today. Similar to Apple, where back in October we could see $1 strike differences on the Apple chain, going from the 140, 141, 142, and 143 strikes. Whereas now we're just looking at 170, 172.5, 175, 177.5. Now this one kind of stands out though. There's something obvious with this one between those two different days, as we can see. On October 1st, Apple was trading at 142 in the 140 ranges. Today, it's trading around 177. I didn't see where it exactly ended today's trading day, but it was trading much higher. And that was the big difference. The stock price, we knew, was one of the factors that would change the strike differences. But HPE is at the same price. We went from $15.44 on November 8th when we had 50-cent intervals, $15.39 today, and it only has $1 strike intervals. So to help Robert out, I went through a lot of different searching on CBOE, the OCC, and eventually I came across an SEC document from April. I'll show the link here, but really it relates to Rule 19.6, which relates to the series of options contracts for open trading. Back in April, they outlined new rules for what they would allow for strike intervals on particular securities. On page 9 of this document, they mentioned that the changes that were made were in order to limit the total number of options available across the exchanges. And I can tell you, working for an options data company such as Power Options, I can agree with that. Got a little untenable at some times, and that Thursday morning when those new weekly series are released, we haven't crossed the Friday expiration yet, we see the most number of options as those new series comes out, and it can cause some problems from time to time depending on how many there are. But they included this nice little graphic which breaks it down into tiers. It's not only based on the stock price, it's also based on the average daily option volume for that stock per quarter. And that's something I didn't know. I didn't know they were doing both of that when they made this change in April. What we see here is that stocks that are under $25 per share can offer 50-cent strike intervals, as HPE did back in November, only if their average daily volume, and I think this is over 90 days, this is why they do it per quarter, but their average daily volume across the entire stock is greater than 5,000 per day. If the stock's under $25 and the total option volume is between 1,000 to 5,000 on average over the last 90 days or the last quarter that they evaluated, they can only offer the $1 strike differences. And if you're a lower price stock and you see average volume of 0 to 1,000, you can only offer the $2.50 strike difference as opposed to $1.50 strikes. This is why you see many stocks that might not be as liquid as, say, Ford or even HPE only offer $2.50 strikes, even though they're $12, $13, or $14 stocks. Now, 25 to 75, the second tier there for stock price ranges. If you have an average of greater than 5,000 average option volume, you can offer the $1 strike differences, and you can do it at 1,000 to 5,000 as well. However, less than 1,000 contracts per day, on average, it would be a 5-point strike difference between 25 to 75. 75 to 150 is the next tier, and then 150 to 500. If you're greater than 5,000 average stock volume, you can offer the $5 strike differences only, not the 50 cents and not $1. So right away, now that I knew this, now that I found this little write-up here and this little example, it made sense what happened to HPE. During the last quarter, they must have dropped below 5,000 average daily option volume over the last 90 days, during that last quarter that was analyzed, which was strange because we do have a running current average option volume for every stock on Power Options. You can see that on the stock details page. And HPE has an average volume today of 5,967 over the last 90 days, I believe. So it is possible that HPE could go back to the 50-cent strike intervals that it offered back in November if this average volume stays up. So new series released maybe for February or for March or for April might have that 50-cent strike difference, as well as new weeklies that might come out in a couple weeks for the January extended series and into February. It's a possibility. Apple still does have $1 strike differences on some of the expirations in the lower strike range. A couple of the weekly series for the 23rd and the 30th, I believe. They offer $1 strike differences intervals between 135 and 150. But the new option series that have come out past January all offer only those 5-point strike differences above that 150 price range, if they haven't already been released and didn't already exist in the market before it had to change, with Apple going to 177 and falling into that third tier, third or the fourth tier, I should say, of that 150 to 500 strike range, or stock price range, I should say. So I just wanted to share that with everyone, just a little for your information. I learned something new this week. I missed that initial release when it came out in April, so I did not know that they were also basing it on average stock volume in addition to the changes in the underlying stock price. It's now done by both, on stock price and the average option volume from the previous quarter, not current, as we kind of saw with HPE. And I believe, as I said, it's subject to change, so it's possible, maybe much to Robert's ire or much to Robert's pleasure, that HPE could go back to the 50-cent intervals for new cycles coming forward if the average daily volume stays above 5,000. Again, if you wanted to read that document, I think it was 22 total pages with a couple of images such as this in there. The link is there, sec.gov/rules/SRO, CBOE EDGX, the CBOE Edge Index, and other links there as well. Or you could just do a basic Google search for CBOE Rule 19.6, and that will get you to it.